thank you again, IFAS, for hosting and supporting this event. And of course, we cannot leave out thanking all the participants for joining us today. Really great to have all of you joining us today. And in fact, we are also very glad to see that the COVID cases are also trending down these days. We're seeing like lesser than 5,000 cases a day, so that's pretty good. And hopefully, sooner rather than later, we can come out and do live events again. And I think we have quite a 2-year long of webinars, right? So today we will talk a little bit about from farm to fork. This is a very interesting topic because we will be touching on the main key theme of food inflation. I think food inflation is something that a lot of us have heavily underestimated, just because it is not something that we see with our own. We don't see with our eyes, literally to say. So imagine, right? Imagine that you are at your favorite kopitiam, right, and having your usual bowl of noodles, right? And previously, the noodles would probably cost about 5 ringgit, and now all of a sudden, the owner comes over, right, and say, hey, the noodles is costing 6 ringgit today. So we were like, oh, why the increase? And they were like, yeah, costs have gone up, so we gotta raise the price a little bit. So, and most of us at that point of time would not bat at night because it is like merely, a ringgit. But if you convert that into statistic wise, that is a good 20% increment in cost. And if we look at those fancy restaurants, right, a decent meal at a classy establishment before COVID and after COVID would have gone up anywhere between 20 to 50%. So food inflation is something that is creeping up on us every day, right? And when I look at this Global Agribusiness Fund, it is something that can reflect, right, to us as investors to look at the opportunity that is available through this food inflation. So the fund this year has performed quite well, so to say, up by 18%. I just checked Bloomberg this morning. And before pandemic times in 2019, the fund has grown by 17.4%. And in year 2020, despite COVID, the fund has trended up 4.3%. So, whatever the situation may be, right, cost of food is ever going up. So let me just quickly take possibly a minute to just touch on the key features of the fund, and then I will pass on to the experts, to share with you the outlook and opportunities in this area. So Aisha, can you please move on to the next slide, please? So this fund looks at the potential long-term capital appreciation, investing in areas of global agribusiness, so the entire value chain in agribusiness. Next slide. So as you see, we have these gentlemen here, the speakers here. They are from DWS, which is the target fund, and we are very, very fortunate to have the portfolio manager himself alongside with the portfolio investment specialist here today with us. Next slide, please. So this is the little bit of a fund details. The fund has launched since 2007, so that has a 14-year track record. Next, please. And the performance has been extremely encouraging over the years. You may see that the red line, which is the fund, underperformed the benchmark a little bit. This is because the actual comparison is not apple to apple. So this fund is focusing on the companies along the global agribusiness chain, while the benchmark is benchmarked against MSCI World, which consists everything from tech to banks to consumer goods and everything else. Next, please. So just a very quick touch. These are the top 5 holding, which is still maintained today because, you know, as per our disclosure documents, right? This is as per 31st August. So today, I think the top 5 are still intact. Next, please. And that's all from me. So may I now pass the floors to Lars to continue with his outlook and the rest of the presentation.
Thanks a lot for the kind introduction. Thanks a lot for the invitation. Yeah, we are very happy to speak about today to you about agribusiness. As you said, it's a very interesting topic because it doesn't matter how economy will be. If a corona pandemic is on the way or not, we have to eat. Yeah, so food supply and demand of food is definitely still a very interesting topic. And at the beginning, I will spend 5 to 10 minutes to give you a brief introduction about the concept, maybe a little bit about the history, what we want to do with this fund, what is our goal with this strategy. And then I will hand over to Stefan and Marc, so the 2 lead PMs, portfolio manager for this strategies, and they will put the whole performance and also our positioning in the portfolio and frame it in the current market environment and give you some more details about how the current market looks like, what we think could maybe some promising investment ideas where we are currently positioned, and what are maybe some things you should consider here. Let's start with some general remarks, and I like to use for that maybe the slide 12. So if you could bring this slide up. Yeah, it's already here on the screen. Thanks a lot. Let's use this for my general remarks. So the strategy itself it's a really old one. So the investment idea was actually already born in 2006. So the fund has a very long track record. Actually, we were the first mover with this strategy, and it's still alive. This is a very good signal for a thematic fund because I'm not aware of so many themes which have a long-term track record, successful long-term track record. Most of them will be liquidated after a couple of years because it's not really a sustainable theme. And here you see this is definitely different with agribusiness. So with more than 15 years track record, it's still a very interesting theme and still something which is actually considering the current market environment really offer some promising investment ideas and investment pockets at the moment. The strategy was previously managed by colleagues in the US. And until September 2016, it's now managed out of Frankfurt. And here the team is headed by Stefan. He's surrounded by a lot of specialists. And the team is very experienced and did a great job during the last years. Yeah, with approximately 500 million euros, the fund is still one of the largest ones if you compare it to other actively managed funds in the space. And what's quite important before we have a closer look to the investment strategy, we only invest in equity. So the fund is considering listed equities. There is no private equity, and quite important, there's also no direct investment in commodities. So we will not invest directly via future contracts in corn, in wheat, or in soybean. It's only about equities. This is quite important to mention here. So let's speak a little bit about our investment idea. When we came up with the idea in 2006, what was our rationale behind? The rationale was really there is and there still is an imbalance if you think about supply and demand of food. Yeah, and this has to be solved. Yeah, because it's really a severe problem. There are still some people out there with not enough food on a daily basis, and with our strategy, we want at least try to help to overcome the situation and provide here money, so the money which we collect from our investors, to equity companies which are providing here solutions to overcome this problem in the long term. Yeah, and despite the fact that if you compare the situation currently with the situation which we had maybe in 2006, there is definitely more food produced nowadays, but it's still a severe problem. Yeah, even the improvement which we have seen during the last 20 years are not enough. There are still main problems left which we have to tackle. Yeah. And the reason for that is really population growth. Yeah, so we still see that we population is growing. So and it's not only the increasing number of people, it's also the fact that people tend to get older. Yeah, so there are more and more people on the earth which need food. Yeah, and this has to be produced. It's also very important aspect which I want to mention here is also that our eating habits have changed a little bit. So more and more people, especially in Asia, but also in Latin America, this is the case, tend to eat more meat in comparison to previous years. And the meat consumption is a really severe issue, yeah, because you need a lot of soft commodities. Think about soybeans, think about corn to feed the cattle, to feed the pork or the chicken to produce the meat later on. Yeah, and this is also something which has to be produced and to be considered. Yeah. What's also an important driver of the whole theme here is that people, especially in the emerging markets, tend to get richer and afford more things. Yeah, they change their eating habits. They are now go to restaurants. They bought food in a different way. So they are not only cooking at home. So also this has definitely implications on the overall supply and demand of food. Which is something which we also try to consider with our concepts. Yeah. And you see already that it's a multi-layer theme. So agribusiness is not only something which happens quite close to the farmer. It's really something which has severe implications across the whole value chain. And this is the reason why we also consider the whole value chain. Some of our peers decided to focus on specific aspects. In most of the cases, it's downstream. But we really think, and we are still convinced of that, if you want to really to solve the problem and to provide solutions, you have to consider the entire value chain of agribusiness. And that's why we are starting with upstream. So upstream are the activities quite close to the farmer. So if you think about machinery equipment, for example, tractors also, if you think about seed and crop protection, if you think about fertilizers, which you need if you grow something, all these companies belong to the upstream part. Yeah, but if you as a farmer, there is a day in a year where you take on your crop and then it has to be transported. Yeah, and that's why also the midstream, so also logistics part is quite important for us to consider as well. Yeah, because also here you have to really take care that not so much losses occur in the transportation segment, yeah, because you can only produce once, yeah, and then you have to ensure that not so much will be lost on the way to the food production hubs here. Yeah, and the last part is for sure downstream. So this is really all the companies which produce the food, but also sell it. So if you think about restaurants, supermarkets, and so on, all of that is part of the downstream segment. Yeah, and if you frame it together, then you will see maybe on the upstream side, it's really the main goal is here really to produce more, but also here to do it more in an environmentally friendly way. So this is nowadays a very important topic. On the midstream, again, it's really to prevent as much as possible losses. And on downstream, it's really to tackle the food waste, yeah, because also food waste that you buy more than you need is really it's still a very severe problem which we are currently facing. Yeah, so the theme itself, as I said, the idea was already born in 2006. But if I think about the investment universe, there was a lot of changes. So a lot of new companies are now part of our investment universe, and new topics evolved over the time. If I think about big data, so the whole digitalization thing is also now a quite important part, and I'm sure Stefan will provide later on maybe one or two examples. Is also an important part and aspect of agribusiness. So there are a lot of more and innovative solutions which you can now consider also in the agribusiness space here. Also self-driving vehicles. So if you think about a tractor as something which is now possible and which is definitely also helpful to reduce costs and maybe provide a higher output. Yeah, but also a better application of seed and crop protection is something, if you think about environment, which is quite important and where we definitely need to progress further. Yeah, and last but not least, I like also to mention the organic food trend. Yeah, also this is a topic which is which was maybe not so prominent in 2006 and which is now quite more important and where we see very strong demand driver for that. Yeah. to bring it in relation to current topics, and we already speak about food price inflation. This is definitely something which currently plays a quite important role and which we already have seen in the prices of the soft commodities, but also supply disruption is something which we definitely have to consider when we are talking at the current moment about agribusiness. Yeah. Last but not least, I want to mention also why it's from a portfolio perspective quite interesting to consider the entire value chain. If you do so, then you have also you can benefit from a better risk diversification, because if you think about stocks within the different segments here, you will recognize quite easily that the price of corn or wheat play a quite different role. So take a farmer. If a farmer is able to sell corn at a higher price, he is able to earn more money, so it's good for him. But if you think about a food producing company like Nestle or Unilever, to take a European example here, they have to buy corn to produce maybe a bread later on, and for them it's input costs. So higher corn would mean for them lower margin. So that's why it's quite interesting from a portfolio manager perspective to consider, or at least have the flexibility to consider the entire value chain, because you can, depending on the market environment, you can really play around and try to find the most promising investment ideas and diversify risk in a much better way. Yeah. And with that, maybe enough for my introduction. I like to hand over to Stefan to speak aloud about the topic in the current market environment. And maybe Stefan, you can also speak a little bit about the team and how you set up in terms of research and who's providing which ideas. Yeah.
For sure. And hello from sunny Frankfurt. Thanks, David. Thanks, Lars, for the kind introduction. A lot has already been said. What Marc and myself try to do over the next couple of minutes is to dig a little bit deeper into the topic of agribusiness, and maybe starting with the team. Please, operator, can we go to the team slide? Perfect. To give you a short overview, we are 3 people on the fund. So I have a lot of support from Marc and Madeleine. We are in one team. There's a lot of experience, and Marc is our consumer staples head here for DWS. He is managing the research for the entire platform, and he's the deputy of mine for the agribusiness strategy. And so is Madeleine, our young talent in the team, I would say. She started basically coming from university directly a couple of years ago, and is very eager and keen to learn. And she has already built up significant knowledge in the industrial space, which is also a key subsector for us. So ag equipment manufacturers, tractors, combines, but also railroads, that is her coverage, and quite an interesting topic at the moment. And just a quick word to myself. I joined DWS 1.5 decades ago, worked a lot on the commodity side. And since 2015-16, we took over the agribusiness strategy. And that's what I try to give you a little bit more details on. From the subsectors, maybe it is a good thing to show another slide. Operator, could you go back a couple of slides? Couple of slides back, where we see the coverage from the different members.
It's actually slide 15, operator, slide 15.
Perfect. Thanks, Lars. Yeah, exactly. There it is. What we've done basically is to define the whole universe, what subsectors for agribusiness is important for us. And when we say this, quite catchy phrase, from farm to fork and everything between, we really mean it. Yeah. And as Lars has already alluded to, the upstream part is what we think is everything from the tractors, from the ag equipment, but also the inputs, so seeds, crop protection, and fertilizers, which are right at the moment the largest exposure in the fund. Here there are a lot of topics. As you might know, even though world population is growing, so are the yields of a lot of crops. So it's not mainly about expanding acreage. A lot of improvement were from actually the yields. Yeah, and you can see here who is covering what from these 7 very important subsectors of agribusiness. It's not only Madeleine, Marc, and myself. We have a lot of support from other team members as well within DWS. There are, for example, the colleagues Christoph Ohme. He is covering the chemical names in Europe for us. Markus Poppe is our head of industrials. He has also a very keen eye on the sector for quite some time. He sits next to me here in Frankfurt. But we also have a couple of other colleagues like Paul Buchwitz, who has a focus on clean energy and tech to some extent. And these people are all helping us to come up with new investment ideas. So it's not really the 3 of us, it's the support from the whole platform here. And everyone is sitting here in Frankfurt, and that is very, very helpful. I think this is a huge advantage for us running the strategy if you compare that with rather niche boutiques where only 1 or 2 people are responsible for a strategy. So we can really leverage the DWS global experience. We have more than 70 people covering equities globally, and that is a huge help for all of us. But talking a little bit about not only the team, but why we think agribusiness is interesting right now, and what might has changed over the last couple of years. I have to clearly say we are in a very, very strong position in agribusiness right now. The environment is very, very good. That has not always been the case over the last 8 to 9 years. Most of the time, grain prices were quite low. Farmers hardly made a profit. A lot of them, especially in the United States, were even loss-making, and they heavily relied on government subsidies to actually come up with a break-even. Yeah, but that has changed last year in summer, basically. So 2-3 months in the pandemic, we've seen huge demand coming out of China. Some of you might know we had this huge African swine fever event in 2018 in China, where a lot of the porks had to be culled due to the virus. The virus is harmful for the pigs, but not for humans. But given that China is the largest producer of pork and also consumer of pork globally, that had a massive implication on the global meat chain. And China really tried to replenish and import a lot of grains, so namely soybean meal and corn meal, to feed to their new pigs, to the headlet, to rebuild that. And therefore, we've seen strong price moves in the futures of corn and soybeans. So compared to a year ago, we are up 50% in the soft commodity space, and that is helping the whole universe. So not only the farmer, who suddenly is profitable and has a huge incentive to maximize his output, he also has the incentive to buy the best seed out there, to apply more fertilizers, to guarantee to have a very good yield, to maximize profit. But that is the fundamental change. But also, you have to keep in mind, agribusiness is a seasonal business. We also have seen very poor harvests coming from South America. There was a very rainy season. Yields were lower than in the last couple of years, especially in Brazil and Argentina. In the second corn harvest, what we call the safrinha harvest. So stock-to-use ratios is one metric we always closely monitor, and this stock-to-use ratio, so basically you're comparing supply with demand on an annual basis, has fallen rapidly over the last 1.5 years. Yeah? 2 years ago, there were sufficiently inventories out there, especially in the States and South America, the 2 largest exporting countries for grains, and that has halved over the last 1.5 years. The last time we have approached such a low inventory level was actually in the last super cycle in 2011-12, where a lot of grain importing dependent countries have seen riots in their population. North Africa is is an area which is highly dependent there. Arab Spring was established basically on food shortages, and we are not far away with regards to the inventory situation here. So everything has become more expensive. We've seen costs rising. Of course, with higher energy prices, diesel is getting more expensive, so it's getting more expensive to produce crops. And the inputs are also a main driver. So seeds, crop protection have seen huge price increases. We've heard that from all the companies basically in this earnings season. But one of the largest components for the farmer is actually fertilizers. In the developed agribusiness world, around 20 to 25% of the costs are linked to fertilizers. In the emerging markets, it's even higher. It's probably a third and more. And the fertilizers are basically there to keep the crop healthy, to ensure that it will grow, to build up resistance. And there are three nutrients which we are watching here, which is potash, nitrogen, and phosphate. And we basically have all of the producers in our fund. And here, from the beginning of the year, we've seen price really rallies. Nitrogen prices are up 250% from the beginning of the year. You have to know how to produce nitrogen. You need basically energy to transform it into energy, so in fertilizers. And one of the major inputs is coal in China, and here in Europe and in the United States, it's gas. And gas prices, I can assure you, here in Europe are a very hot topic. Electricity prices are increasing on a daily basis here. Gas prices have more than quadrupled over the last couple of months, and that is the main input for fertilizers. Actually, there have been companies in Europe shutting down production because the energy costs were too high, so it's not profitable anymore here in Europe to produce certain fertilizers, which I have never seen in my entire career. The good thing is we are invested in a lot of US companies. Here, gas prices has risen as well, but so have the nitrogen prices. So we've seen earnings basically triple for these companies. And that's so important for us because this part of the upstream world, which a lot of our competitors are not invested anymore, is booming right now. And we are happy to have the top holdings in that field. What is also important to keep in mind whenever there are price rallies and huge movements, you have to think about what does it actually mean from a valuation point of view. Is this price level sustainable? When you look back in history, normally the best cure for high commodity prices in the long term are high commodity prices, right? Because producers try to maximize their output. But this time it could be a little bit more different because due to all the supply disruptions we've seen within the chain, there are a lot of materials not being able to be delivered. And that is a problem mainly from a logistical point of view. That's why this area is also very important for us. So railroads or storage companies, container shipping companies, they are all in the sweet spot right now because prices to transport a commodity from A to B is really moving higher. And in that industry, there are not so many participants anymore. There have been a huge consolidation. I mean, in the United States, there's just a handful of railroads anymore. Container shippers, 10 years ago, there are more than 20 companies out there. Probably these days, the top 12 is 90% of the market share. So they're starting to see pricing power, which is extremely important in this inflationary environment. So if you compare the valuation levels for a lot of these agribusiness companies, the agriculture chemicals, what we see on the upstream side, they are trading very, very cheap from a historical point of view. They are trading on 50% discount to the overall equity market, although their earnings have risen far, far more than the average market. And that tells you that the market is not really believing on the sustainability of prices. And we do. And that's why we are so excited on that area. And with regards to the sector itself, Lars said that in the beginning, yes, it's true. People need to eat. And we've learned that from the pandemic. quite heavily how important it is to have secure supply changes to be able to provide the population with food. Yeah. Sometimes when I discuss the different sectors here within GWS, I tell the colleagues from tech, I truly believe mankind can live without Facebook, Apple, and Amazon going forward, but certainly not without food. Nevertheless, if you look simply on the PEs or on EV/EBITDA, so the metrics with which we evaluate if a stock is expensive or cheap, all these companies from the agribusiness space seem to be rather cheap, and some of them trading on 10-year lows with regards to valuation. And I think that is a good opportunity for investors to have a more balanced portfolio, not so much focused always on the growth names, on tech, etc. Because here you get an industry which is probably the oldest industry in mankind, which will be needed not only in the past and right now, but in the entire future as well for humans. And that's what makes me so excited on the sector. Yeah. And maybe finishing up before I give the floor to Marc is they are not only these themes you see here on the slide, there are obviously a lot of new trends emerging within agribusiness as well. So there are topics like digital agriculture or precision farming. So where we have support from big data for the farmers to really optimize their daily decisions, maybe to apply exactly the right amount of fertilizers or pesticides for their fields they need and not wasting a lot of the inputs. So it's a minimum maximum decision where farmers are supported. Yeah? We have also topics like vertical farming, which is extremely interesting from my point of view. COVID has taught us that supply chains are quite long, and people are reliable on, let's say, the Americans on the tomatoes from Mexico. Yeah? But nowadays they're starting building up large greenhouses where they actually plant on a vertical basis, even in cities, layers and layers and layers of leafy greens, of tomatoes, and they don't use any pesticides for that. So it's a clean environment. You only need energy and water, but you have a very, very good quality of these crops. And the logistics are minimized because you can transport that maybe directly to your Kroger's or Walmart's or wherever retailer you wish. Yeah, and that is also a new trend emerging. You can keep transportation costs low with that vertical farming approach. We also have plant-based products nowadays. So basically a substitute for the classical meat or even for milk. Yeah, you use not the classical milk anymore, but let's say oat milk or soybean milk, almond milk. That is emerging and is growing in market share. So it's not only the classical subsectors we are closely monitoring. We really do everything, including supermarkets, aquaculture, even food delivery is on our coverage. So basically you pick up your phone and order, or do it obviously online these days. There are also several listed companies which we think are interesting. And if you are in a market where only one or two are, the margins are quite attractive. Yeah. But without further ado, I think it's a good time to pass over to Marc, who can give his thoughts and view on the consumer staples side and why we see agribusiness also as an inflation hedge from that corner.
Yeah, thank you, Stefan. So first of all, I will talk a little bit about the current situation where we are in, and then I will talk a little bit more about top-line challenges, and finally about pricing and inflation. Coming out of 2020, we have seen we had a much higher demand for at-home food with work from home, learn from home, and social distancing. We spent much more time and, of course, much more meals at home. So we have seen a huge increase in volumes for staples company and real big sales growth for retail. At the same time, we have seen that away from home consumption shrinked dramatically, but now with the reopening, we kind of see a recovery. But at the same time, we recognize that food consumption at home stays elevated. So it's really important to see on the one hand the improvement, on the other hand the elevated levels. And imagine you're just staying one day at home, working from home. It's already an increase of 5% of your food consumption at home. So it's a real big swing factor. And in the US, for example, before the crisis, we have seen that more or less 50% of dollars spent for food are spent outside and 50% at home. Volume-wise, a little bit different, but we have seen the big swing. So we currently see an elevated volume number for the producers. This is one point. The other point is people started to consume much better food. So if you stay at home, you wanted to indulge yourself, you started cooking from scratch. For a lot of consumers, the first time they used to order it or used to go somewhere to have their dinner, and now they started to cook the first time. So it's a real change in consumption patterns. And there we have seen that the people started to spend more on that food. They spend better for better quality, or maybe themes like Stefan already mentioned, for organic food, where the price obviously is higher, but the return for the consumer is also higher. So we have seen the volume component is higher, the premiumization trend has worked. We cannot only see it within food, but also with pet food or wine and spirits and coffee, for example. If you think about your Nespresso machine, your Starbucks capsules you're using, so this is all up trading, better quality. So the current challenge for the consumers will be, or consumer companies will be, what's the new normal? So if we see that sequential reopening, what's the new volume number they are going to sell to the consumer? So it's not quite clear yet how much time will be spent at the office or maybe at home. This is a volume effect. The second effect will be, will we see, for example, down trading? Now inflation coming in, will the consumer try to save money in consuming cheaper products or not branded goods? So that will be quite interesting. How strong is the stickiness with that premium product? So this is a quite interesting point. And of course, finally, the most important topic for the next, I would say, 24 months for the sector will be how's the pricing working? How will companies cope with inflation over the next few quarters? We have already seen that there was pricing last year, and we have seen high inflation last year. But throughout the second and third quarter this year, we have seen a fast acceleration in inflation. But we also have seen second round effects regarding pricing. So talking to companies, to CEOs, they say, okay, we are talking to our retail customers. This is all on C level. It's really important for the retail. It's really important for the consumer staples company. And they're saying, okay, actually, it's working quite fine because inflation is everywhere. It's not only the raw material, it's wages, it's freight, it's logistics, it's additional costs for COVID. And you have to price for it because you have to earn your margin to reinvest into future. So this is really important currently, but actually it's working quite well. And the key question will be, at some point we might see some price elasticity, and how big will the headwind be for most companies? For the time being, it's working actually quite fine. But how do we adopt that to our portfolio? Actually, we are going to invest like we have done before. We are focusing on certain areas where we think it will be an advantage for those companies being there. It's like for premiumization. There are some big European food producers. They are very big into pet food. They are big into coffee. This is, I already mentioned it. It's really working quite nicely. Innovation, having products for new consumption patterns, like meat-free, meat alternatives, or oat milk, stuff like that. It's really important to have a really good product for the consumer when he demands it. Or just a strong market positioning. If you have a quite consolidated market, you are able to price. You are able to get your pricing through, and so the retail is aligned with your interests. If you are growing, the retail is growing, and everyone is fine. And finally, attractive niches, like in meat alternatives, for example. This is very precise area where those companies invest into it, and then you will benefit and you will get your pricing through. So all in, I think we are very optimistic regarding the pricing power of branded goods companies, and we do see opportunities to invest, and actually good chances for them to cope with the situation. And but you have to be very, very selective.
Marc, Stefan, could we use slide 30 and 31? So 30 is the sector and country allocation. And the other one is a thematic change over time, that you put the ideas where you have a very strong view currently in perspective, so that our participants have a clue what's behind these sectors and where we can find the ideas within the portfolio.
And maybe I start from my side, because probably it's a part of my part of the portfolio is a little bit more boring than that of Stefan. And of course, we do face some headwinds, so our development is not as dynamic. But for example, on the sector side, packaged food and meat, 16%. You see, it's strong, it's working, but we are not too much overweight in it. But it's a story we strongly believe in it, and there are areas. Actually, snacking, for example, everyone loves chocolate and cookies, and this is quite recession-proof, and people indulge themselves and they spend their money on it. So it's not that exciting, but this would be, for example, a good example.
We have a keen eye and a focus within the consumer space, as Marc said, on the multinationals, on pricing power. That is working. We see it here in the earnings season. There is a difference between low quality brands and high quality brands, and the high quality names are able to pass through this cost inflation they see, and they are increasing their organic growth numbers quite nicely. And that's why we hold these defensive, strong companies. And maybe to add also from a country allocation point of view, you hardly see a huge exposure to emerging market from the country allocation. So that is basically where the company is listed on what exchange. But we have a huge revenue exposure indirectly to emerging markets, because most of these multinational large cap companies are listed in the States or in Europe, but they have a huge part of their portfolio in emerging markets. So don't be mistaken, the actual emerging market exposure is far higher than suggested by this country allocation you see on that slide. On the sector allocation, I've talked a lot about fertilizers, agriculture, chemicals, so the upstream classical names from materials. That is a third of the portfolio, and currently have the strongest earning power we see. And I think it's not the end of the race. Given the valuation levels of these companies, they have further room to perform from my point of view. And the other sectors are really other niches. Food retailer, which are basically supermarkets, a small exposure only here. We've built up railroads, even pharmaceuticals, that is basically animal health companies. Some of the specialty chemical names, they have a lot of exposure to specialty ingredients. So fragrance companies are rounding up the portfolio, I would say. And that gives you a nice balanced approach between the really high beta stuff, which you want to own in such environment, but also some of the more defense name to really secure that volatility within the product is not running out of the need there. And that's the current position in the fund. And you can also see on the slide where we have the development of the sector exposure, maybe operator. Yes, exactly. Here you can see over time the allocation to sub-themes. And here you can see that we clearly build up the green part, the fertilizers, over the last 1.5 years, which were, from a timing perspective, are quite good, because that was right the start of the rally within fertilizer prices. And that is the largest overweight, so to say, in the fund right now. And I would say with that, we would open the queue for questions you might have on the strategy.
Stefan, one last wish before we do so. Could we also go to the ESG slide where we illustrate, let me look it up, what we consider in terms of ESG, because I already looked in the Q&A section, and there are some questions also regarding sustainability and ESG. So it would be slide 24, operator. If you could show also this slide so that we could have a quick remark on that as well. Thanks.
Yeah. From a portfolio management perspective, we have certain rules, and it's not a dedicated ESG fund, but obviously, I mean, all these three factors have relevance in our investment decision. Not since 1 or 2 years, but basically since we launched the strategy. For me as a portfolio manager, is of utmost importance to rely on the management. If incentive schemes are not running out of control, if it's prudent, if I invest in a company where the CEO gets millions and millions of dollars, and the size of the company is not that large, we would highly question that. So the corporate governance is a very important point for us, and we are speaking on annual shareholder meetings where we address sometimes our thoughts and views on the management and the boards of the companies we are invested in. From an exclusion point of view, we have made clear that there are certain areas where we basically would rule out being invested, which is from an ag perspective, illegal pesticides or companies which are involved in deforestation. We would clearly rule that out. As Lars pointed out, there's no exposure to soft commodities via futures directly. This is an equity fund, so very, very plain and easy to follow. And we also said and that is basically the only real subsector where we don't invest, is tobacco. Yeah, I mean, that is also a crop which grows. So a couple of years ago, we had exposure to that, but we decided to exclude that sector for the agribusiness strategy. Everything else is included, and it depends on a case-by-case basis, obviously, if we invest. But generally, we need to know the management. We know the companies we invest for several years, sometimes decades, and we have good relationship with them. And for us as a fundamental fund manager, this research and the dialogue with the companies is of utmost importance for us to come up with a decision to be invested for the long term or not. Lars, would you like to add something? Did I miss something on the exclusions?
No, totally fine. Yeah, I saw one question regarding CO2. So maybe when we start with the Q&A section, we can also make some remarks here. But with that, maybe it's good to hand it over to the operator to kick off the Q&A section.
Thank you, AmInvest and DWS for the insightful presentation. We will now take some questions from the floor. If you have any questions, feel free to type your questions in the Q&A box. Okay, right now, the first question is actually from YouTube. It's by Cornell. Price of food is rising, but is profit or profit margin growing for owning an agri asset considering the current supply chain disruption?
Yeah, that is a very important question and a good one. And we are obviously talking with the companies on that point. And I would say you have to clearly make a difference between the companies which are able to pass through the cost and the companies which are not able to do so. So on every dollar of cost inflation, there's some companies maybe only giving 50 cents, pushing 50 cents down to their customers. So that would mean naturally margins are declining. And from the earnings season so far, and the last earnings season, we've heard from a lot of consumer names that raw material price increases are more or tougher than previously expected. And that's why we really emphasize that it's important to have good brands, companies with strong brands, with pricing power, with global networks, which are large clients for the logistical companies. Because when you are a ship operator or a railroad and you have only certain containers, yeah, I mean, what you're going to do? Will you say to a very small client, which when you have very few business with them, yes, I guarantee you a container? Or would you say, oh no, I will go to my largest clients because that is the most important one, and certainly he gets the container. And so logistical problems for the very large companies might not be as hard as for the smaller private or tiny ones. And that's what we're actually hearing from the companies. And that's why we are really happy to have the broad, large multinationals in the consumer space.
I mean, maybe to add something on that one. So maybe we see 1 or 2 quarters with a real margin headwind, especially on the gross margin side. And actually, we look then quite detailed into the P&L, looking, is this company making up their operating margins through savings on advertising and promotions? And this is really essential. You can save some money on that one, but actually, in the long run, you will destroy brand equity. So for us, maybe it's temporarily that we see a margin pressure, but for us, it's more important it is to look, is this company able to preserve at some point in time their margin? Maybe on a quarterly basis, you might see negative or lower margins, but then on the yearly or trading 12 months basis, is this margin troughing out and recovering? And this is quite important here. So yeah, there will be a time lag between costs and pricing, but often it closes very fast. And currently what we are hearing, at least for consumer companies, year to date on average, roughly 5% pricing. That's probably not enough to cope with costs, but it's going through very, very fast, and the time spent for price negotiations are actually quite short. So we should come out of the first quarter with better numbers, probably. Yes.
And for the upstream sector, I mean, again, there are magnificent times right now. Even though, yes, there's raw material inflation for them as well. So inputs in some cases are up 50%, but their end product prices have doubled or tripled in some cases. And you have to keep in mind, the farmer in the end of the day sells his corn now for $5.50 per bushel. So the last 10 years, the average price for corn was $3.50. So he has an additional $2 to spend right now. So that basically means for the upstream sector, the whole pie is growing. And a lot of these companies will benefit from that environment right now with increasing margins.
Okay, thank you. As for the second question, I think this is quite a long question, so I'll break it down into 3 questions. Sustainability, environmental protections, and CO2 emissions and adherence to the measures required by many to be certified as sustainable are key pressures on food producers now, often with increased costs and time requirements. What weightage do you place on these certificates and criteria in your stock selections? The second one is, do you question the credibility of these certification schemes? And the third one is, the worst for deforestation and the CO2 emissions is by far the beef industry. How do you treat them for investment?
That a lot of questions. Okay, let me try to answer them chronologically. On the topic sustainability, yeah, obviously, this is not only the zeitgeist, so to say, but a topic which is always included into our investment decision. Because if you have a business model with a focus on sustainability, what we've learned from history is that plays always out in the mid to long term. Sometimes not in the short term, because it means there are potentially higher investments in maybe in your asset base, in your plants. But in the long term, there's a huge benefit. I mean, there are keywords like circular economy in a lot of the chemical names, for example. So they're trying not anymore to produce products which are based on fossil fuels, but trying to find natural ingredients which are recyclable, which are reusable, to really improve their efforts on sustainability. And what has changed over the last 1 or 2 years, actually people are ready to pay premium prices for these kind of products. That's the huge difference. I mean, for 5 years ago, if you have a product which are based on input costs which come from the recycled world, probably not any of your clients were eager to pay for it a higher price than the standard product, because you simply say, oh no, that is a drag to my margins. And now their stakeholders are requiring it. You see the movement really, really going and developing quite well, and that is helping anyone to make the world a better place. Although this sounds sometimes a little bit naive, but the companies are actually taking huge sums of money to invest in these projects, in these green fields. And the feedback we receive from them is that everyone is aware that that is actually a huge request from the society. And if everyone is improving on a yearly basis, we can see the results. And the very good thing is, for example, for the food industry, if you use more and more recycled package, the quality is improving as well. When you had maybe a couple of years ago not the standard on the recycled packaging, you don't get any quality certification for your packaged products. That is changing as well, because there's a lot of investment in that strategy, and that is helping. Yeah.
Maybe to jump in at that stage, it's really important to look through the lens of a food company CEO. We talked to one a few months ago, and he said, ESG costs are normal costs. These are costs which will occur on the future on a regular basis. This is no special cost, it's normal cost. You have to put it into your calculation, because either you spend that money and consumers will consume your product. By the way, they are probably not going to pay much for it, but all the people who are not spending that additional costs, they will price themselves out of the market, and consumers will leave that product aside. So you have to really check your P&L and find solutions how to finance those additional costs. But consumer is not going to pay it, but you have to spend that money, otherwise you won't sell any products anymore. So it's really important, and companies have understood that, and they're spending their time on it. And now it's our part to see which company is doing better than the other company.
And there's certainly differences out there. I mean, a couple of years ago, probably the average American company was not very much interested in ESG or in carbon footprint reduction. That certainly has changed. Most of them have sustainability reports, which are quite detailed. Some of them are really like 200-300 pages. So you get a lot of information which you can address in the discussions with the management. Coming to the question on CO2, here I think we really have to develop a better understanding, because sometimes I have the impression that there's just a request to lower CO2 generally, which is necessary, obviously, to fulfill all these commitments about net zero and also the discussions in Glasgow right now. But you also have to keep in mind there's some of the companies in the agribusiness space, and we also own, which have a very high carbon footprint because their business model is to produce fertilizers. Yeah. So you, as I said, you take energy, basically gas, and transfer it into nitrogen, into ammonia, urea, UAN. So that by itself creates a lot of carbon footprint. We cannot say stop it because otherwise there won't be any fertilizers. So our yields for the crops globally would drastically being reduced if this entire industry suddenly stops their production. And that would not be a help for anyone globally, especially not for the people which face hunger these days. And they are still there, unfortunately. Yeah. So I think we have to redefine that a little bit, because you got not only a negative on the carbon footprint side from the production, but a huge positive with regards feeding the world. Yeah? And that is, by the way, also an SDG goal, which is the number 2. And sometimes I think these companies are getting not enough credit for that, because people are looking only on carbon footprint. Having said that, there are also is also a huge effort by these companies to actually reduce their carbon footprint. Yeah. So basically, for the fertilizer industry, there are huge new topics like carbon capture. So basically trying to capture the CO2 in the process. And we call that, for example, blue ammonia production. Fossil fuel based is gray. So basically input is gas. Blue is you take the carbon, the CO2 into the carbon, and you store it underground in salt caves or so. That is obviously more expensive from a production point of view. But again, people are more and more eager to pay for the end product a little bit more if you have the guarantee, okay, this is not produced by the classical old fossil fuel way, but by carbon capture. So they're eager to pay a premium. And the last step would be, for the example fertilizers, would be green ammonia production. And we've seen the first field plants within companies here in Europe, but also in the United States, where you basically don't use any fossil fuels at all, so no gas, but you try to bring renewable energies coming from solar or from hydro in, and then you have a chemical process to basically produce ammonia, not in the old way, but in the new green way, so that you basically have no carbon footprint at all. From a production point of view, this is today 4 times more costly than the old standard, but companies moving more and more into that way. And we are encouraging them, obviously, to do so, because that means in the end a lower carbon footprint for a classical industry, which is helping everyone. But people need to be ready to pay more for these types of product. And that's why we think this portfolio is a great inflation hedge, because the energy transition is moving in that direction. And we are investing in a lot of companies involved in that theme.
But also you really have to look at it a little bit more smarter. If you produce a soap, it's scope 1 and 2, but scope 3 is not in your hands. So if you, let's say, for example, water, it's a consumer who has to change his consumption patterns. But for example, with meat alternatives, this is something very interesting for us to look at it. Do those business model succeed, and how can we participate with it? And then also the footprint is getting much better. So we have a close look at it.
Yeah, and maybe lastly on the deforestation question. Yes, you're right. There are, particularly in Brazil and Argentina, so in South America, always news popping up that there's illegal deforestation in the Amazons, but in particular. And we have massively reduced our investments in companies from South America, from the meat industry. I mean, currently we don't hold any of these anymore. The only thing we are invested in Brazil directly, in Argentina, are classical farm operators, but they are focused on cotton, on soybeans and corn. The problem with the meat producers, the cattle producers in South America, is always to get really transparency on where is their cattle, or very often the cattle belongs to a small farmer and not to the companies. Where is it put on? Yeah, and how is this land used? Because in South America, the animals are not grain-fed in plants like in the United States, but they're simply going out and eating their grass outside. Yeah, and to have these plains, very often, sadly, the Amazon was being cut down illegally to make space for the cattle, and that is certainly a thing we don't want to see. But again, it's sometimes very tough to see because the company is saying we don't own the cattle and land, we are just buying from the farmers. And that makes it sometimes not so easy to really have a visible view. Okay, who is part of, who is the actual cause for the deforestation? But again, currently we don't hold any meat producers within the agribusiness strategy. We are more focused on US names and European names.
All right, I guess that answers the question. As for the second question, the palm oil industry is now enjoying historic record high product prices and record profits, but there is a strong negative correlation between product price and palm oil stock prices now. Why aren't palm oil stocks attractive to large investing firms, presumably including your firm, in your view?
Mm-hmm. Yeah, that's also a good question, particularly from the region. I mean, there are a lot of producers in Malaysia. What we have faced over the years when talking to these companies, especially the very large ones, and apologies because I cannot speak on single names in this call for compliance reasons, is that we do see that the larger companies are eager to improve from an ESG perspective, and that includes globally accepted certification for the ways palm oil is produced, which are, to be honest, seen quite controversial from the European and also from the US perspective. And that's why we decided, we first do see other very attractive opportunities out there within the ag space, so we don't have to focus on palm oil. And also from a food point of view, there's also a tendency that large companies try to reduce their exposure to palm oil, which is a tough task, to be honest, because you use it in so many products these days. But really, I think the performance of these companies have a discount due to this ESG and certification debate we are having in the global markets. Investors are not ready or accept any questionable answers, or maybe not crystal clear certifications, or really don't want to be in the newspapers seeing being invested in one of the companies which might have controversials on that area. It is easier to move to other parts. Although, yes, I do see the palm oil price itself. I mean, it's highly attractive, but I think the ESG overhang a lot of these companies currently facing is simply too large to attract a lot of large cap institutional investors. I mean, this is a long answer, not quite crystal clear to your question, but it's the best I can give you from my perspective.
All right, thank you. And the third question, does the current disruption to US port operation have any impact on the fund? And is there a way to assess such risks from happening in the future?
Yes. Obviously, we all have not thought that talking so much about logistical issues or harbor data from LA will be a part of our daily work routine. But the problems we are facing right now, or a lot of these operators are facing, on the other hand, gives us new opportunities. Yeah, and over the last couple of months, we have digged a lot into the logistical area. Like I said, we have increased exposure to transportation, to railroads. We also own shipping companies these days. I mean, a lot of these companies have free cash flow yields of 20 or 30% right now. The largest shipping operator in the world, which is also listed, I think they create a free cash flow this year, which is larger than what they earned the last 8 years combined. And again, I think that is also not only a fact due to the Corona crisis and the huge demand, but also from a long time of underinvestment and of consolidation. I mean, the trucking industry in the United States, I mean, it's highly fragmented. There's not really a huge player. There are thousands of smaller operators, and people simply are not willing to drive to work anymore for a $40,000 paycheck. They have now huge pricing power, all these drivers. What we've heard actually 2 weeks ago, Madeleine told us from one of her earnings calls, there are sign-up bonuses now for US truck drivers. So you basically just need a license and you can apply being a truck driver, and you get your contract 5 minutes later, and on top $10,000 signing bonus, which really never has been the case.
For high quality drivers, you already reach in some parts a 6-digit number.
Yeah, I mean, that is really puzzling and amazing. But what we think it's prudent, it's not only focusing on what's going on the streets. I mean, there are also other bulk transportation possibilities, rivers, barge, railroads, and of course, over time, these disruptions will solve it out. But what is clear, we need a lot of more investments to avoid this situation we have right now. And I think all participants within all industries are moving a little bit away from just in time to just in case, so to say. So having a little bit more inventory to really avoid a situation right now. And that is good for the whole infrastructure and transportation logistical industry. And that's why we are invested there as well.
All right, thank you. And next question. Does the fund invest in farmland?
Not directly, but via the equities. We do have exposure to agricultural producers, so farm operators. These are basically two ways. One are really operators which own the land, and then there are ones who lease the land. But direct farm exposure to really being on the ground in South America and buying land, that's not our expertise. We are relying on the companies operating there, because they have the relationship, the knowledge, and they have the proven track record of being a good operator. And especially, as I said, in South America, there are 2-3 very promising companies which were able to show over the years, over the decades, to increase production and efficiencies, and we are happy shareholders for quite some time in them. They are normally more on the grain side, so corn, soybeans, a little bit sugar exposure through sugarcane operators, and also cotton producers, basically.
Okay, and why is there an allocation in France?
In France, let me think. That is a tiny exposure. Give me a second. France was. Do we have the slide?
It's actually not on the country slide, so that's why we show where countries with 2% and less, but it's not.
No. Yeah, so that is, and I actually cannot think of a direct France exposure right now in the fund.
But Stefan, is there any stocks which were in the past part of our portfolio? So food producer or supermarkets. I think so. That we
Yeah,
have some
Danone.
France companies.
Yeah.
We used to own Danone.
Yeah. That is one of the large producers. That was part of the portfolio. There might be one of the specialty chemical distributors as well listed there, but that is only a tiny position. So they're basically, their business model is to transport organic nutrients from A to B.
But also I think also some supermarkets are part of our universe. So overall, it would be possible that we would also have exposure to French companies. But it's not currently the case.
Okay. In the interest of time, we will take one last question. This agribusiness is something new for me. To understand the performance of your fund, is there any relevant index or similar funds to benchmark your fund with?
Stefan, maybe let me answer this question, and then you can think about the realistic expectation of your annual return for the next 5 years. So let me coming to a proxy. This is, to be honest, quite hard to answer, because by considering the entire value chain, there is not really so much other funds which are doing in a similar way. And if you want to use a specific index, you will also end up with a slightly different exposure, because the index normally have a very strong focus on upstream names. Also here, within the index, some of the stocks have a higher listing than 10%. So it's not an index which would be eligible for us to compare the fund, because as a mutual fund, you are not able to invest more than 10%. So because of that, you find some, for example, the S&P Global Agribusiness Index is some index, or is an example for an index which gives you exposure to the agribusiness, but it's not in a way that you have really the entire value chain, and also not in such a diversified way as we like it in terms from risk diversification. So that's why yes and no. There is some indices which you could use, but it's maybe not a proxy if you want to compare it with our fund. And with that, Stefan, maybe a short word on your return expectations for the next years.
That's good. Perfectly answered, Lars. Just maybe to add, what is important, because the strategy is so broad, we really like it to have a lot of positions in the fund, and a lot of the index, the agribusiness index from S&P only has, I think, 20 components. So we have tripled the size, and that means also that we have a lower volatility than that index, which is very important to the strategy and for us. Return expectations, I mean, obviously no one has the crystal ball. I cannot tell to you next year we will achieve 25% return. I won't do that. But what I can tell you is, looking back, we had, on a relatively basis, 7-8 very poor years in agribusiness. That changed last year with a lot of the names starting to perform. And again, I would make the argument that the valuation levels currently are very attractive. Versus the last 10 years, a lot of these names are really cheap. And you cannot say that to a lot of sectors within the global equity markets these days. I think it's a good hedge for inflation. And I think certainly over the next decade, the strategy should generate a solid investment return, and probably also being able to outperform the global MSCI world, given all the reasons we have talked about over the last hour. So I think it's quite a promising time. That's why I said we are in very, very solid environment for agribusiness companies. And I think there's the chance, because the market is not fully buying into that right now, given the low valuation levels. But I think a lot of the prices can stay longer than currently expected. And that is a huge tailwind for a lot of the names we invested in. So therefore, I think their performance expectation going forward is quite solid.
Perhaps I can chip in a little bit here. I think one of the questions the attendee asked was, what any competitive peer that they can also consider. Well, in Malaysia, we are the only agribusiness fund that is available, and that is also even listed on Lipper, one of the areas which tracks all the unit trusts in Malaysia. And in terms of the return, if you check our latest fund fact sheet, the past 5 years has actually returned an investor about 51%. So, but that is the historical performance. And yes, there we go. So that was the last 5-year performance. But I think last 5 years and 5 years going into future may not be similar. I think moving forward, there are probably, even more opportunities in terms of food inflation, because one of the things that we do look at is that in some of the consensus that we receive, it is said that by 2023, world population would reach 8 billion, and by 2037, world population would have reached 9 billion. So demand for food and the inflation would certainly, come along that lines as well.
Exactly.
So back to you, Joanna.
All right. Thank you. That was an insightful Q&A session. All right. I think we have come to the end of today's webinar. If you have further questions, feel free to send us an email at investhelp.my@fundsupermart.com. A replay of today's session will be available right after this. Head over to our YouTube page at FSMOne Malaysia to catch this replay. Our next webinar session will be with Kenanga Investors Berhad on this coming Thursday, 11th of November, where we'll be talking about positioning for phase transitions. If you haven't registered for this event, please head on to our website now at www.fsmone.com.my to register. Once again, thank you very much to David, Lars, Stefan, and Marc for joining us today. And thank you everyone for attending today's session. Good night.
Thank you, Joanne. You have a great night yourself.
Bye-bye.
You too.
Take care.